What is good, guys? It's Rey-Jay back with another video, and in this one I wanted to talk about some trading emotions and give you guys some more lessons about the world of trading. I'm not going to make too many, important claims about the market from a technical standpoint right now, but I'm going to use some historical data to give you some understandings about how the market could mess with your emotions and how you should be able to contain them, and some important lessons you could probably learn from someone like me. And before I say anything like this, let me just mention a couple of things. I'm firstly not a financial planner. Take none of this as financial advice. And don't forget about the Moomoo link. The offer ends very soon. Put in $100 in your guaranteed 5 free stocks with a $100 cash reward. Anyways, let's talk about the market now. What on earth is going on? Well, here's the thing, okay? When you are trading in the stock market, okay, you have to remember the importance of emotions. And what do I mean by that? Emotions dictate your trades almost every single day, whether you realize it or not. And on top of that, having too many wins could work against you. What do I mean by that? If you are too confident, okay, and if you're overconfident and you just think that you're getting this trading thing and you just start winning and winning and winning, you may make the mistake of trading too much and not following your disciplinary rules. So if you have a small account that has like only, I don't know, 10,000, 5,000, 2,000, or whatever, what you want to do is, first off, what I would do is maybe use a cash account because you could make a lot more trades with it and you don't have to worry about the pattern day trading rule in essence. But the thing is, if you're using one of those, you have to be able to limit the trades to not make like way too many trades in one day or risk too much of your portfolio, because your money, first off, could get locked for the day because the funds have to settle. And then on top of that, you have to gain this mentality where you don't really hurt yourself for missing out on every single big move. But going back to the emotional aspect of it, like one of the things I learned in the markets is that you have to stick to the discipline. Meaning that if you have like I was about to say, like, I don't know, $5,000, right? You could make a plan where you never trade with more than 1,000 or like 1,500 a day. Never use more than that in one day using a cash account. And then you only make $300 trades, and even risking like 1,500 would be kind of excessive, maybe like 1,000 at the most. And you only make $300 to $250 trades. So you can make just like 4 trades a day. And then you want to just watch for the setup, right? You want to watch for the setup. You don't have to watch the market every single minute of the day. I only trade for the first few hours of the day and sometimes during power hour, not always, but I tend to finish most of my trades during the most volatile times, which tend to be during the first 2 hours or so, maybe 2 to 3 hours. And that's going to be a lot more beneficial for a lot of people. Now, to add on to that, your emotions could get the best of you because if you are winning and winning and winning, let's just say that you're trading with I don't know, a $5,000 account and you're only using like $400 per trade, or not 400, 300 or 250 per trade. If you keep winning, you might be so used to winning that you start risking 1,000 per trade, 2,000 per trade. But if you take a big loss and you don't use a stop loss, you could just blow half your account very, very fast. Now, another thing that's very important would be being able to adopt different strategies that allow you to change your mindset. And what do I mean by that? The market switches on a dime so fast sometimes. Okay? Sometimes it just flips in a snap. And if you want to succeed in this market as a trader or a scalper, you have to be able to play both sides on a day-to-day basis because so much could happen quickly. And let me give you an example of this, an example of what I did, for instance. So just a couple of days ago, right? In the morning, the market was looking a little bearish. I think this was on Thursday, not too long ago. On Thursday, the market was looking a little bit more bearish, and we're getting some signals suggesting we may get a sell-off because we were, trying to sell off, and this was a fake out move before a lot of these institutions and hedge funds started buying in, which caused the algos to start pushing the market higher, right? In the morning, okay, in the morning, the moment we open, let me just pull up the 5-minute chart so you can see the fluctuations a lot more. And I'm going to go back to Thursday. In the morning, before I had any of the data right here, when I saw this, the market starting to sell off, the 4 hour got a bearish cross on the PPO. We started to look a little bit weak, and then we got this, big drop before we got a small bounce, but I didn't see us hold above the 200 EMA. So I was looking for a potential short opportunity in the very beginning, and many of us could get faked out. Then after the beginning, as the market started pumping, I got stopped out. And I saw the trend after the first couple of minutes. We looked very strong, and it looked like the market was going to keep going. So that was maybe about 15 minutes in. So instead of chasing after puts spreads, or whatever it is you wanted to do, instead of chasing after selling covered calls or trying to short the market in any way, shape, or form, I adjusted my strategy because I realized, hey, the market's holding above the 15 to 200. We're on a very strong uptrend. We got very good volume, and we're about to see the technicals shift. So what I did was I adjusted fast. I took a small loss on my short position, and I switched basically. And I said, this thing is starting to look very bullish. We're getting confirmation. It's pushing. We got a back test right here. This was another good entry right around this support level. And then what I could do is I could bring back my drawings basically, because we broke above this resistance quite quickly. This was an opportunity and a signal that the market is looking strong, it's looking more bullish. I was looking at the bigger time frames, like the 30-minute, the 4 hour time frame, and I knew the market was starting to look stronger. That's why I released another video later on at that time. And I started switching completely. I flip-flopped, and that could be a good thing. Then I started playing the calls. And what happened? The market kept going. It broke above 440, was holding up quite nicely, got a back test. It did not break 440. That was another signal for another potential entry. Then it kept going, got a slight rejection off 442, came down, and then it just pushed through it and went all the way up to almost 444 for another potential exit. Right, the resistance would have been 443.75 right here. We went just barely above it, and that's like a take profit level for a lot of people. See how I adjusted fast. So you can't be too attached to a position, right? You can't just say, I'm going to short the market. It's going to crash. And try to short every single minute or look for short opportunities every single minute. That's not the way to really do this. The best way that I found, especially in a market like this, which is very volatile, is read the trend, figure out what the market is doing, and then be prepared to enter and potentially even exit quickly. If you're trying to day trade or scalp, swing trading is a lot trickier in this market, but it is still possible. And I just wanted to note this. Risk management is important, and being able to understand the fact that even the best traders in the world are going to lose money. Trading has its risks, and it's not the market's fault. It is us who are adapting to a much larger market. So you have to control your emotions to not become too attached to a particular piece of a trade or some kind of option, and manage your risks, because things could go south at any given moment sometimes. Let's just say there's a bad piece of news out of nowhere. Something really bad happens just hypothetically, and the market just starts selling off out of nowhere. It could cause someone to lose their money. And when you know this, managing risks can give you more opportunities to keep trying again. And you have to use stop losses adequately, and you have to understand your emotions. If you are going to a big funeral or something, may not be the best time for you to be trading, because you may be very emotional, and becoming too emotional could slow down your abilities to make rational decisions. Same thing with anything that happens in your daily life, like a breakup or losing someone you love, for example. Those things could affect you big time as well. And you have to do what's logical and rational. Now, let me also add that you have to adapt, because the market is constantly changing, right? There's some instances where the market is pumping very hard. Then there are other instances where it's cooling off, other days where it's just trading sideways. You have to identify the next support and resistance level, what's holding, by looking at a bunch of different time frames, looking at your VWAP, for example, look at the 15-minute, The 15-minute 200 EMA is what held us up today, stopped us from like dropping harder. And you have to just keep like looking around and just studying the charts and then realizing what is holding up better. Right now, a strategy that's working would be looking at the 30-minute time frame for the direction. The 30 minutes working very well as of right now. It's probably going to continue for some time too, maybe going into next week. The 4-hour is working very well as well for the bigger direction because we're about to get a bearish cross on the PPO, but we still need some confirmation first. Confirmation levels, the 4-hour time frame, the 30-minute, and then the 5-minute tend to be some of the best indicators to look at. Sometimes you could even switch to the 15-minute just to see support and resistance, but those are the particular levels that are working a lot better, the different time frames, and we could adjust depending on the market structure. Because in another, couple of weeks, I might not be paying as much attention to the 30-minute. I might start paying more attention to the 15-minute, for example, right? And right now, what's working really well is watching supports around like the 50 EMA and the 200 EMA. It's working very well, but this could change in the future. This could change depending on what the market's doing and depending on if we are in a choppy period or not. So this is the importance of letting go. Let go of those emotions that are attaching you to puts, attaching you to just calls, and just go with the flow. Look what the market's doing. Look for direction. Let the market tell you what you need to do. Today, there was a good shorting opportunity after we got this rejection off this 442 level as the market broke below the 50 EMA. This was a chance, especially because we knew a sell-off was potentially going to happen. This was a good opportunity. I also want to warn you guys that the 0-day to expiration options are a trap for retail investors because a lot of people are new to the markets and they try really hard to make as much money as possible as quickly as possible. And they're risky. So the way I would play them is you enter them and you exit them pretty quickly. Okay? I would not hold 0-day to expirations for way too long across all this volatility. It could be very, very tricky. And it's designed to trick you and me to get the premium and the money from those options to the market maker's hands. It's a trick. It could work very well if you learn how to play them, but like I said, you have to be willing to take losses. If you take losses, it is what it is. Manage your emotions, control yourself, and don't forget, your emotions dictate you big time. I will talk more about this in a more like detailed video, but always remember, follow a set of rules and be disciplined. Your discipline can be cut short if you win too much or if you lose too much. If you lose too much, you can become very emotional. If you win too much, you can become overconfident, and that can cause you to take bigger risks. Stick to the plan, be as patient as possible, and control yourself. And last but not least, remember to breathe when trading. Be cool. Hunt for opportunities. Don't chase too much. Okay? Do not chase. Hunt. And that's what I have for this video, okay? Hopefully some of this knowledge could benefit you. Hopefully you learn. And hopefully you all achieve a lot of success. Success cannot be forced upon anyone. I can't force you to succeed. I can't force anyone to do it. It is based off circumstances, who you surround yourself with, your environment, and also if you are learning from mistakes efficiently. It's not just hard work. It's about learning to work more efficiently, learning to better yourself after mistakes, and learning from your mistakes. Okay? We all make mistakes. We're all human, but we have to keep our heads up and make it through tough times. I believe in all of you. I want the best for all of you. And I do believe if you're watching this channel every day, you have dedication to the markets. That's already one step in the future, and you're making progress. So never give up. Keep remaining rational. And I believe if you keep learning from your mistakes, if you keep improving, your best days are yet to come. Thank you for listening. Have a great day, guys. Enjoy the weekend. I hope this video brought some value into your guys' lives, and I'll see you guys very soon. Thank you, and peace out.